Hey everybody, and welcome to my latest YouTube video. Thanks for tuning in. We're going to take a look at what's going on in the gold and silver markets. A lot of indecisiveness, a lot of doubt around at the moment about the precious metals bull market. Also the US dollar and what that's doing, also very crucial, of course. And I'll take a look at crypto as well, because that's something I've been dabbling in just recently, and some interesting developments there as well. So this is my YouTube page, of course, and if you click on the About tab, if you like this sort of analysis and you'd like to get lots more free analysis on precious metals, uranium sector, which is hotting up nicely, or has been for a while now, and cryptocurrencies and other things as well, like the dollar and um, other related sectors, commodities and that kind of thing, well, just click on the link and you can get your free weekly newsletters written by Steve Penny, who is Silver Chartist on Twitter, contributions from myself and Patrick Karim, Jeff Clark as well. So yeah, you'd be daft to pass up that opportunity. There's also a ridiculously cheap paid for subscription service that you can sign up to as well that Steve puts a lot of work into, so I'd thoroughly recommend that. I've been getting lots of positive feedback on that, so if you're going to be investing in these sectors for a while, I'd highly recommend it. Anyway, moving on. So what's going on? I thought I'd show you the 10-year Treasury note. If you haven't heard of this before and you're new to all of this sort of thing, the US government issued Treasury notes. They are basically sort of government debt, if you like, with a variety of maturity dates. Now, this is the 10-year maturity Treasury note. So holders of the 10-year note will get their money back at the end of 10 years, and in the meantime, they'll be paid a rate of interest. And the rate of interest is shown on this chart here. That's what the graph is showing. At the moment, it's the interest rate is around about 1%, 1.1%, that kind of thing. So you can see that on the side here where it says 10.91, that's 1.091% interest. We fell all the way down here to around about 0.4% interest, or 4 basis points as they're called. And all the way up to the top here in the late 1970s, we climbed up to around about 153 basis points, or 15% interest. So during this period in the 60s and 70s, we had rapid inflation, rapidly rising yields on the 10-year Treasury note. Since 1980 or 81, we've seen it decline steadily as interest rates have been reduced. Of course, Paul Volcker introduced some pretty brutal interest rates here to dampen down inflation. And ever since, it's been unwinding with ever decreasing, although cyclical upturns, but ever decreasing trend on the 10-year Treasury note. Okay, so that's all very interesting, but what does it mean? What it means is that we're getting into a period, I believe, that's comparable with 1970s and 60s, and that's because we've had a false breakdown. And when you get a false breakdown from a trading pattern, the move to the opposite direction is often rapid, violent, and decisive. So it appears now that we're broken down and we're back in the channel, or back in the megaphone, if you want to call it that, or expanding wedge formation, that we're heading for the top resistance line at something like 2.6%, 2.5%, 2.6%, 2.8, yeah, about 2.6. So my charts have been pointing to something bad happening around about 2023, leading down into the low point in gold in 2024, late 2024. Of course, we've got the US general elections in November 2024. I suppose the running candidates will be announced in 2023, I guess. Is that right? I don't know. But if it is, then that ties in as well. And something's going on with the economy in 2023 that coincides with the T-note reaching its resistance line, and the gold cycle, the 8-year cycle having peaked and dropping down into its 2024 low point. Last time that happened, of course, 2007, 2008, and we all know, the financial crash that accompanied that. So I'm just wondering if this is a critical point here with the Treasury note breaking out at that point. Of course, all hell would break loose if that was to happen, because it would be more than obvious to anybody who even glances at these charts that we've got a problem on our hands, and that monetary policies of the last, what would it be, 40 years are coming home to roost. We've got an indicator on the bottom here, the moving average convergence and divergence indicator, the MACD, and you can see we've just had a bullish cross, so that supports the start, just the start of a possible or probable sustained up move. The zero line is up here, so as and when we cross the zero line, then you tend to be gaining momentum. So that's the backdrop. My suggestion is that we're about to enter a highly inflationary period, and you can see what happened to the price of gold last time that happened. Went from sort of $30, $35, passed through $180 within a short space of time, and then rapidly accelerated up to $800. So you're increasing by an order of magnitude. In other words, you're adding a naught. So you've gone from tens of dollars to hundreds of dollars. It's taken 40 years to go from hundreds of dollars to thousands of dollars. We're up to nearly 2,000 now, so we've added another naught to the figures, if you like. So with a starting point of roughly $2,000, if we were to add a naught to that, as we did in the last highly inflationary period, then $20,000. It sounds crazy, doesn't it? It sounds absolutely ridiculous. I'm not going to forecast that because it's so ridiculous, but I would say that a target in this inflationary period of $5,000 to $10,000 gold by the late 2020s, or I'm going to have to consider actually whether the pullback in the late 2020s in gold is going to be relatively short-lived and followed by an even greater inflationary period in gold prices. That's obviously many years ahead, so plenty of time to think about that. But just focusing on the next few years, it looks like inflation expectations, if not actual inflation, are going to pick up, and gold can do extremely well in those circumstances, as you can see here. Okay, so let's look at gold. And here we have the chart for gold, and you can see that we've had a basing pattern over the last, ever since the high in 2011, and we've pushed through the horizontal resistance levels, broken out to the upside. Now we've come back to test the breakout. That's a really common thing to have happen, of course. If I go back on the chart to look at historical examples of that, you just have to bear with me. There's one here in the 1990s and early 2000s where the chart goes blank, where you can see that we formed a base or a low point in the price of gold. It then came up and it actually hit the horizontal resistance level and backed off before breaking out, and then back testing, and then off you go. And all this sort of behavior is entirely normal. As price approaches it from underneath, it acts as a sort of a buffer and pushes price away like a repelling magnet. Once price is above it, it carries on acting like a magnet, but not a repelling magnet, an attracting one. So it attracts the price back down to that horizontal resistance level until there's enough momentum, energy, buying pressure to catapult price away from that magnet. That's another way of thinking of support and resistance lines. They're like an invisible force field acting as a line of attraction, or a line that pushes price away. Okay, so trying to sort of look at another example and going back to the 1970s, and this is the example I think is comparable to what's going on today. Taking me a while to scroll this thing across because whilst I'm recording a video, it slows down my computer, which is quite annoying. So you can see that again in the 1970s. I'll just bring the chart up a little bit. Price came down to a low point and then accelerated upwards, just like what's happened recently. Price accelerated away to the upside and was pulled back down before the forces of the bull market took hold, and away she went. So that's what I'm expecting. That's why I think that the price behavior at the moment is nothing to worry about. These cups don't always, as you can see, they don't always have to form a handle that comes all the way back down here. They very often see a small pullback, breakout, and then another small pullback. And so the pullback that we've seen in gold so far from, let's call it 2050, it was a little bit more than that, I think, down to was around about $1,800. That kind of pullback is entirely normal, to be expected after this very long uptrend. Now, to try and measure where we're going to go next, one way of looking at this, if it continues to play out, is that we have a bullish flag or pennant formation here. And when you look at smaller timescale charts, what I mean is when you zoom into price action over the last 12 months, this flag pattern becomes more obvious. I'll just draw it on there for you like that. So a way of calculating a technical target is the height of the flagpole. This is the flagpole here. So it started off at somewhere around about, we'll call it $1,200 for a round number, and we'll call it $2,000 up here for another round number. So that's $800. So when price breaks out, you add $800 to the breakout. So if it breaks out soon, breakout level would be around 1900. Just calling it 1900 for easy calculation. So 1900 plus 800 gives you a target of $2,700. Now my initial targets, calculated from other methods, give me a high degree of confidence that we're going to reach between $2,300 and $2,500 as an initial consolidation level. But if this plays out, then we're looking at 2,700. So there's a range of targets, upside targets, that could take us up to here. What I suspect, or my original thoughts were, that we would get up to maybe 2,300, 2,400 in this quarter, so by April, before having a consolidation period through the summer, and then an up move to 2,700 by the end of the year, or towards the end of the year, before we start pulling back over the winter period. But that's all quite a long way off yet. We've got to get to 2,300 first. So we need to see this bullish flag break out, and we don't really want to see it breaking down below this horizontal support level, because historically it doesn't happen, and it would set alarm bells off. Now we're on the monthly chart here, so one other thing you can look at is the moving averages. And the 12-month moving average is a good either 300-day or the 12-month moving average. I've gone past it, haven't I? Too much talking, not enough concentrating. So moving average there. And the 12-month moving average should support price during a bullish uptrend. So it always puts on the 9-month moving average for some reason. I don't know why it defaults to that. And I'm using goldprice.org here, by the way. It uses TradingView software, and I just use it because all my charts on TradingView are saved, and I wanted to start with a blank chart. If you're wondering why, you go to goldprice.org, it always starts with a blank chart, as opposed to one of my saved charts. So if I just make that line a bit thicker, perhaps so you can see it. A bit more clearly. There we go. So you can see back in the 2000s, apart from the cyclical 8-year cycle low in 2008, the 12-month moving average supports the price all the way up. So again, that's another level you don't want to see the price falling below. And putting pieces of the jigsaw puzzle together, the 12-month moving average is now very close to $1,800, which is also the level of this, roughly the level of this line. So it looks to me as though price is getting boxed in by the 12-month moving average and this consolidation period that we've just had. A breakdown below these levels would have me concerned. I'll just put the arc on for you as well. Of course, the North Star arcs are quite well known, I think, by now. I find them everywhere, and they work. They do work. I've been working in the crypto space as well, if you've been following my posts on cryptocurrency. Okay, so there's the, is it doing that? There's the arc, which is really clear. You can see very good, very well respected arc there. When I say well respected, I mean price has respected it incredibly well. And every time prices approach that arc and the moving average, it's bounced back off it. So we've got the arc there as well as the horizontal resistance level and the rising 12-month moving average. On top of all of that, the stochastic indicator in a bull market, as you can see back here during the previous bull market from the early 2000s, the only time it dropped below the 55 to 60 area was during the 8-year cycle low. We're not at an 8-year cycle low at the moment. So that's in 2024. So I don't want to see the price falling below, well, put it down at 50, we'll be generous and call it 50, I call it 55, I think. So this sort of level here, I really want to see the stochastic turning up in unison with gold price moving up and bouncing off all those converging levels that I mentioned a moment ago. So that's gold. Okay, and there's the levels to watch, and the breakout level for gold, if you're wanting that at the moment, is just zoom in a little bit for you. So the breakout level would be close to $1,900. I'll do some more posts on this, but it's in that sort of $1,880 to $1,900 sort of level. Of course, 1900 is a key sort of psychological level, and then the next hurdle would be the horizontal resistance somewhere. Well, the monthly close was, it's hard to tell exactly on this chart, but around about 1980. So we need to break above that to absolutely confirm the new uptrend. Was it 1980? Or I think 1965 rings a bell for some reason. That's another level that people are looking at. So there's some levels up in the sort of high 1900s that we need to break through. We'll look at silver now, and silver a little bit different to gold because it hasn't broken out of its arc yet. Got a large arc here, which I won't draw because that's fairly clear, and it's quite a long time in the past, of course. And then we've got a smaller arc here, and not just an arc, but also trying to draw a line here. It's not going to let me. Okay, here we go. I'll get there. Don't worry. What happened to that? Don't do this at home, guys. There we go. So round about there, and here, I think. So you can draw this different way. I mean, that's one way of drawing it, and there's another way of drawing it, which actually is, when you zoom in a little bit, fits things a bit better, is with parallel. You get the idea. It's a trend channel I'm trying to draw, but because the chart's too small, it's making it hard work for me. But So we can work out some targets from this breakout because it has broken out of this channel. So if you take the bottom of the flagpole down here at around about $4 and the top at 50, it's about $46. So a breakout here at 14, that would give you about 14 plus 4 up to 50, so it's $46. 46 plus 14 is 60. So there you go. So there's a target up around $60, which would probably, well, it would take us through this inclining sort of pivot line. It was support, it's now resistance. And if we sort of move upwards fairly quickly now, we'll encounter that somewhere around about $35 actually, if we move up this year, $35 to $40. Probably likely to pass through that and then come back down and test it from above if the $60 target is going to be reached before we turn down into the 2024 low. But I'd like to see us just moving out of this, whether it's a megaphone pattern or a channel, remains to be sort of seen yet because the price action is still developing. But something else to notice is that the TRIX indicator has only just moved above zero, so we've got a long way to go in this young bull market. The stochastic indicator is trending upwards as well. If I just zoom in a little bit, you can see higher highs and higher lows. So my expectation was for one higher high up here somewhere with a very sizable upwards move before we see some kind of longer pullback, and we may well come back down to test the arc here, perhaps next year. I'd like to see it sort of break up and then come back down and then move back up. But we'll see. I mean, that's all in the future, one thing at a time. And the MACD indicator as well, of course, is only just starting its climb. That should take it way up here before ahead of the 2024 cyclical low. The US dollar, obviously key to all of this, and it's been this is the red line at the top is the arc on my sort of inverted arc formation, and the rising red trend line here goes all the way back to the early 2000s, so it goes back a long time, and it was supporting the dollar index, but now of course the dollar index has broken down below it. It's back tested it from below, and it seems to be sort of losing its grip on that attempt now. Any further upside movement I'd like to see contained by one of these downtrending resistance lines, currently around about 91.5 thereabouts for the top one. If you look at what's been happening just over the last few weeks, we've had a sort of consolidation period here which broke out to the upside, and I think is a false breakout. You can put it on the 4-hourly chart, zoom in a little bit. Each candle is then 4 hours rather than 24 hours. And you can see how we had this false breakout here, and then price came back down through the apex. The apex is where the two lines meet, and then it's back tested it from underneath, which is usually a very bearish sign. We'll see. I think we've got a Fed meeting next week, haven't we? The Federal Reserve, is it the 28th, if memory serves me, next week. So it'll be interesting to see how the dollar reacts to what is said at the Federal Reserve meeting, whether it mounts a rally or passes through, well, the lower red line at 88.25. It's a little bit out of position here, I think, but 88.25 is a very crucial point because that ties in with the low point at some time ago for the US dollar. And if we pass down through 88.25, then it's lights out for the US dollar for some years to come. And that's my base case, my baseline scenario. Okay, so that's the US dollar, and the level to watch here for upside resistance at the moment is around about 90.8 well, it's near enough 90.5. Call it 90.5, that sort of level. Don't really want to see it passing back through that, because then this will become support again and could support an upwards move to 91 point, whatever it was I said before, 91.5, which will put pressure on the metals, which is not really what I want to see. Bitcoin, I mentioned, I'll talk about cryptos for a little while. Bitcoin had its breakout at around about $20,000, and I was shouting about Bitcoin when it had its big breakout back down off the bottom of this chart at $10,000. So if you've been in the trade since $10,000, you'll be doing okay. This expand again. It's another expanding megaphone type pattern at the moment, and these can morph and transform into different types of consolidation patterns. So when you see me changing them on my charts on Twitter, it's not me just changing my mind all the time. It's price action redefining what kind of a pullback or correction that we're having. It can start off as a triangle, pennant, flag, and it can morph and change into a much bigger formation. So something that starts off on the hourly chart looking like a small pullback develops on the 4-hourly chart into a bigger pullback, and then on the daily chart, and you zoom out, you realize it's actually part of a much bigger pullback. And I have cautioned several times that 30 to 40% pullbacks in Bitcoin will happen on the way to $100,000 or more. And at this point in time, I'm focusing more on the time that the cryptos will top in this cycle. I suspect sometime in the summer or the autumn of this year, or if you're crossing the States, the fall of this year, is when we'll see the cyclical top for cryptocurrencies. I'll be turning pretty cautious once we get into the early summer months. In fact, probably even once we get past April into May, I'll be turning fairly cautious. So that's Bitcoin. Went up to $42,000 or so, and we've come all the way back down to less than $30,000. So a good sort of 25% pullback. Could we go down further? Of course we can. As I said, 40% would not be out of the question. So that would take us down to somewhere around $25,000, down here somewhere, back to this level, this horizontal support level, and it could take place over a few more weeks. How long has this been going on? So since January. So we've only been in it for 3 weeks, and they can continue historically for 4, 5, 6 weeks, looking at the last Bitcoin bull run. So buy on weakness, hold. That's my strategy here. I haven't been shaken out of all of my cryptocurrency positions. I did have a bit of a gut feeling that this was going to go further and longer, as you probably saw on my tweets. So I did liquidate some of my positions and redistributed them amongst other cryptos, and Link was one of them. Link is up 16% today so far, and has broken out of its megaphone pattern, which is very positive. We'll have to wait for the daily close and see where it closes at the end of the day. But Link is one of the cryptos that I went into at the expense of Bitcoin, because the Link to Bitcoin ratio seems to be suggesting that Link will be gaining more than Bitcoin, and certainly on today's evidence that seems to be the case. And you can see, in fact, cryptos that I've got shown up here, Bitcoin is one of the poorer performers if you ignore Ripple, which is probably a good thing to ignore Ripple at the moment. It's I'm not really going to comment on that. I'll be talking all day if I do. And Stellar Lumens was another one that I positioned into, because again the ratio chart suggested that it was going to outperform Bitcoin, and also because of this flag formation, which has a base of somewhere around about 0.12, and the top is around about 0.35, so about 0.23 added to the breakout. So you're talking about a move of not far off 100% pretty rapidly, I think, once this breaks out. So I wanted to be in on that, even though it's meant accepting some initial losses. I think I got in somewhere around about 0.29, I should say. It's that sort of level, I think. I thought it might just break out here. 0.29 to 0.3 was when I got in, so I still got some small losses on that. Didn't time it very well. Hands up, I don't get it right every time, but I'm in the trade and I've done very well because I got in back down here somewhere. So with all the cryptocurrencies, when they began to break out quite some time ago last year. Okay, so I think that's about it. We've covered quite a lot there. I don't want the video to go on too long. So if there's anything in particular that you want covering, leave it in the comments. Don't forget the Silver Chartist newsletter. Lots of free information comes through into your inbox every week on that. And as I say, you can sign up for some crazy cheap price for a much more detailed specialist trading advice from Steve Penny. So I'd thoroughly recommend that. The link is on my Twitter feed, and the link is also on my YouTube details as well. So thanks for listening, and more later. Bye for now.